All right, everybody, in this video, we're going to be going over how we finance our apartment buildings. If you don't know who I am, my name's Antoine. I've bought and sold 1,500 units, single family and multifamily in the last 10 years across the entire country, but mostly in the Midwest, Ohio, Michigan, Tennessee, Illinois. And I started a real estate fund this year buying apartment buildings. We have 2 buildings fully closed. We're working on another 2 buildings that we have under contract. And people always ask us, how do you actually get the money to buy these apartment buildings? So today in this video, I'm going to show you our exact playbook in simple language, because we all like it very simple. And if you want to see a live deal we're working on right now, click the link top of the description. It'll take you to a deal that we're working on right now. You can check it out and see all the live, real juicy numbers. All right, in this video, we're gonna go over the big idea, who we like to borrow from, what's a good loan look like, so like our kind of like internal checklist, when we don't use Fannie or Freddie, not all brokers are equal, step-by-step process, simple numbers, red flags to avoid, and why we repeat the same team over and over, and then we'll wrap up the video. So first, let's go over the big idea. So every deal has 2 buckets of money. Let's say we buy a building for $100, we use $80 from debt from the lender, and then $20 in equity from us and our investors. So our goal is to pick the loan that gives us safe payments, long runway, and 0 personal risk if the market turns. Couple of different people that we like to borrow from and why. We mainly use Fannie Mae and Freddie Mac. These are called agency lenders. They are government-backed lending programs that focus on apartment buildings. They like stable properties with real cash flow, which all of our properties do. All of our properties typically cash flow like 8 to sometimes 12% cash on cash return annually. So this is just the cash flow that they spit out is like 8 to 12%. Their terms are usually fair, and most important for us, the loans are usually non-recourse. Non-recourse means if something goes wrong, the lender can take the property, but they can't come after your house, your car, your other assets unless you lie, cheat, or commit fraud. These are called bad boy carve-outs. Okay? Recourse is the opposite. The lender can chase you personally. We don't like that, and we like to avoid it whenever possible. All the deals we've done within the fund have been non-recourse. Before starting the real estate fund, doing single family and doing smaller apartment buildings, we were getting recourseable loans, but I've learned my lesson on that. Again, nothing's ever happened, but I'd rather pay the extra just to like sleep well at night and not to like have the domino effect of like one property not performing to knock out all the other properties or to, affect the other properties, okay? What does a good loan look like? So this is our kind of like internal checklist. So first, we want a fixed interest rate or a floating rate with a real written cap. Typically, we just go for a fixed interest rate. And what the interest rate we're getting right now on these deals is like 6.0 to 6.5%. Depends on the loan size, location, crime rates, all that kind of stuff. There's a million different factors that go into this. Typically, we get 5 to 10 year terms, so we aren't forced to sell in a bad market. And we want some sort of interest only period. If it makes sense, paying interest only for the first 1 to 3 years helps cash flow while we renovate. It also increases the IRR, which is the most important part. If you don't know what IRR is, it's the internal rate of return, the annualized return every single year that our investors make on their money. Now, you want to also have a healthy cushion. So we look at loan to values at or below 65 to 75%. LTV means how much of the purchase price is the loan. And then we also want debt coverage at or above 1.25. That means the property's net income is at least 25% higher than the yearly loan payments. What we have found is that most of our properties are around 1.50x, which is crazy. That's very, very good. That means the property is very, very cash flow heavy. And I think a lot of the deals that we're buying right now are just very, very cash flow heavy to begin with. A lot of the properties we're buying right now are like 50 to 100K per door. A lot of my other friends who have real estate funds are buying properties within that same kind of price range. These typically are going to have very, very good debt service coverage ratio. If you want to look it up later, but it's called DAT or DSCR. Okay. Reasonable prepayment. So this is something interesting too. A lot of people have been changing the way that they've been doing prepayments. So this is something you really want to think about if you ever want to get into your own deals, but it's just something nice to know. We prefer loans that don't punish you for selling or refinancing too early, but sometimes Fannie Mae, Freddie Mac have really, really brutal prepayment penalties. And they also have something called like yield maintenance, which pretty much means like if they don't get their interest, you have to pay the interest. So like if you buy a property, it has a 5-year term, 30-year amortization, which by the way, like these are the loan terms. This is 5 to 5 to 10 year term, but then you also have like a 25 to 30 year amortization. So your payments are still split up over 30 years. It's just like they're saying within 5 to 10 years, you either need to sell or refinance this property. Just an FYI. So yield maintenance means that even if you sell the property in year 1, you have to pay 4 years of interest payments. And so it gets kind of brutal in that sense. In certain cases, why would we not use Fannie or Freddie? If the building is rough, half empty, needs big repairs, a regular agency loan may not fit. We might need to go and get a different kind of loan. In those cases, we may use a bridge loan. Again, we haven't done any of this for the fund, but it's in our back pocket if we ever needed to. And a bridge loan is a short-term loan, usually 2 to 3 years, that helps you fix the property. It's more expensive, but it buys you time to stabilize, and we refinance into cheaper long-term loan after that. Even with bridge loans, we push for non-recourse terms when we can. And there's like a couple banks that will do this. I know one of them is Chase. Next, not all brokers are equal. We have used a couple different brokers over the last 10 years. Not all of them are created equal. A debt broker is a person who shops your loan to lenders. A great broker saves you money and time. A weak one costs you deals. And that couldn't be more closer to the truth. We use the same brokers over and over because they already know our style, our documents, our timelines, and our communication style. When this means style, it means our communication style. Like, they're just like on top of their shit. They respond quickly. They're communicative. They don't give us surprises. And it just makes our lives a hell of a lot easier. Some of the big brokerages you'll hear about in apartments are CBRE, JLL, Berkadia, Walker and Dunlop, Greystone, Newmark, Northmark. Wow. There are others. The logo matters less than an individual broker who actually runs your file track record over everything. So these are some of the biggest ones. Yeah, I mean, all of these are actually pretty big. We use Berkadia, we've used CBRE, we've used Arbor before. It really just depends on you. Like, if you have a personal relationship or connection, hell, if you want one, shoot me an email and I can help you out. If you want some sort of real mortgage broker or anything like that, if you want anything, feel free to reach out to me. If you need any help reaching out to any of these brokers or want a personal connection, just shoot me an email, Antoine@RedBrickEquity, or you can click the link top of the description and I can help you out with that. All right, cool. So this is how we get loans done. First, they're going to send you over a term sheet. So our broker collects quick numbers from the lenders. This is kind of like it's almost like an initial contract. We call it an LOI in real estate land, but it's like almost like an LOI, like, hey, here's what might happen from this loan. Then we apply, we pick one, pay for a deposit, and then we start doing the appraisal and all that kind of bullshit. Then they'll do an appraisal, property condition report, and then environmental report to make sure the site is clean. Typically what this means is like, there's not any like chemical waste. There's not anything crazy on the property that would like environmentally be hazardous to tenants living there. So they'd like to check that. They do an income review. So they check their rent roll, T12. T12 means the last 12 months of income and expenses for the property. And the rent roll is who lives there and what they pay for rent every single month. Then we do approval, we rate lock, and we close. We sign the loan documents, the title company records everything, and we get the keys. So let's go over some simple numbers. So let's say we're buying a building for $5 million. We get a loan at 65% LTV. So we have to raise $1.7 million in equity. That's a down payment plus closing costs plus repair budget plus reserves, right? And the plan typically is light updates, push rents, hold. In year 3, we refinance into a cheaper loan or sell into a better market. And then most of the time we have like a year 5 sale. And this is typically how we underwrite all of our buildings. And I've had people ask me this before, but like, why do you underwrite all your buildings for a year 5 sale? It's because it just makes it easier for us to underwrite every single building in the same exact way. If we like underwrite this building with like a 3-year refi, 5-year sale, and then this one is like a 5-year sale, and this one's a 7-year refi with a 10-year sale, it's like you never really can compare apples to apples. So to compare apples to apples, most people that I've seen do a 5-year sale as just like an easy way to look at a deal. Because you have to sell or refinance in year 5, and you might as well budget for a sale in year 5 because you can always try to sell the property. You can always try to refinance it too. It's just most people want to know they're going to be able to get their money out. So you just always plan for a sale in year 5. And if you cannot sell it, right, then you can move forward to the refinance. All right. So this is just like a simple kind of like showing you if you buy something for $5 million, you got to come up with this much in debt. And then you raise the rest in equity. So you raise equity plus all the other stuff on top of it. Some red flags that we avoid. We avoid short fuse loans. So like anything 12, 18 months, I want to do like a 5, 10, 15-year term. I don't do anything floating rates. I don't do anything recourse. I try to really like get around this prepayment trap as much as I possibly can. Sometimes it's tough. And then optimistic underwriting. So I have Hayato, who's on my team. He does all the underwriting. I'll probably do like some collaboration videos with him maybe. He does all of our underwriting, all of our deal analysis, all that kind of shit. And he also works with the lenders to run through the underwriting with them. So it's kind of cool. Once you go bigger in real estate, you actually have other people running the numbers for you, which is fucking great. Single family, it's like the lender doesn't give a shit. They're like, here's the comps. Okay, here's the money. With this, you have the insurance looking at it. You have the lender looking at it, the underwriting looking at it. You have your investors looking at the deal. So it's pretty crazy. Also, big point here, we repeat the same team every single time. So like same broker, same lender program, same attorney, same property manager, it's all boring, but it just makes everything work so much more smoothly. Like the first deal, we used like a different lender. Second deal, we used one lender, and it was way smoother. And we're just like every single deal, we just make a little bit of a tweak to make things go faster, easier, more timely. Faster, easier, more timely. Improved communication, faster, easier. So it's tiny little things that just make your life as a real estate fund manager, real estate investor, just work a hell of a lot better. All right, wrap it up. That's how we finance our apartment buildings. Prefer Fannie Mae or Freddie Mac. Push for non-recourse. Use trusted brokers. If you want some help, shoot me an email. And only take on debt that still works if the world gets messy. If you want to see a real deal that we're working on right now, click the link top of the description. It'll walk you through the numbers and the loan, and so it'll kind of break down everything for you if you want to see a full picture. If you are an accredited investor, so if you make over 200 grand a year, 300K a year, if you're married, $1 million net worth, click the link top of the description, book a call with my team and I. We'll share the deal we're working on, share with you some past deals, and we'd love to help you all invest in real estate, or maybe invest your 401k or IRA into real estate. So that is all. Thanks for watching the video. See you on the next one.